Hello, and welcome to Carbon Y, the channel that's catered to those who are avid lifelong learners. My channel explores the how, what, where, why the world works the way it does. Make sure to hit the like and subscribe button so that you can get notified of my next video. In this week's episode, we found out how the rich avoid paying taxes. Shouldn't it be that the more money you make, the more you have to pay in taxes? Well, in the US, that's actually not what happens. The super wealthy can sometimes pay even less taxes than the average person because they know how to take advantage of certain rules in the tax code. Just like billionaire Warren Buffett, for example. He pays less taxes than his employees. How is that, you might ask? Well, the reason is because his wealth comes from his stock holdings, not his salary. The thing about stocks is that you aren't taxed until you sell them, and the taxes are usually pretty low. It's a pretty popular belief amongst many people that the wealthy don't pay their fair share in taxes. For example, in 2018, Amazon made over $232 billion in global revenue and paid $0 for their federal tax bill. And in the 2020 fiscal year, at least 55 of the largest corporations in America, like Nike and FedEx, also got away with paying no federal corporate income taxes. How do they do it? Well, some experts say tax breaks are designed to reward the taxpayers who are helping to add to the economy through real estate or businesses. They contribute to economic growth at a larger scale. And those who don't help in that sense don't get the benefit of tax breaks. But how does the rich use the tax code to avoid paying taxes? Well, we have to look at where their wealth is coming from, because loopholes arise when they have assets. But most Americans don't have or can't afford assets. They are solely dependent on their salary as a means of income. So the wealthy are at an advantage here because they have the means to own assets such as business and real estate. And because of this, they're able to explore areas of the tax code that the majority of us can't. How does that saying go again? It takes money to make money. Let's break it down some more. Think of someone's wealth being made up of separate assets that fit into one of three different tax buckets. There's taxable, tax-deferred, and tax-free. Now, if your only form of income is your annual salary, then all your wealth fits into the taxable bucket. But the rich tend to have multiple assets and investments that the tax code doesn't consider to be taxable income, like individual retirement accounts. Some are not subject to federal taxes, and investments like stocks fit into the tax-deferred bucket. As an investor in stocks, you don't owe tax on the gains if your portfolio goes up until you set that stock. And when you do, the tax rate is lower than the rate of wage incomes. Capital gains taxes also apply to bonds and tangible assets like real estate, cars or boats. With the right tax planning, the wealthy know to realize their gains during the fiscal year when they would have big capital losses to offset that gain. They also get away from the capital gains tax by passing their appreciated portfolio onto their successor when they die. Plus, owning properties opens up even more opportunities for the rich to reduce their tax bill. Owning real estate allows you to deduct things like depreciation, real estate taxes, and property taxes. And for the people who aren't investing in real estate for a rental income, but use it as their primary residence, you can itemize your tax deductions on a Schedule A form to lower your tax liabilities. But for those who do have rental properties, you can take advantage of depreciation on your expenses for your real estate properties and enjoy that extra income. And you only pay minimal tax on that additional income. And that's just the tip of the iceberg. The wealthy use a myriad of rules, opportunities, and options to reduce their annual tax bill, like using any one of the different tax breaks for higher education, whether it's the tuition or fees deduction, or the 529 plans where money in certain accounts can grow tax-free. Another way to avoid taxes is by borrowing against the value of real estate or against the value of insurance policies. So, If you take out a life insurance policy with a high cash dividend and then borrow against that from the bank will see that as an actual asset and may loan you up to 90% of the value of that life insurance policy. And that loan effectively becomes income to you. But here's the catch. In the tax code, that loan is not considered income or capital gain. It's tax-free. And these kinds of techniques can only be used by people who have disposable incomes, like the rich. We've all heard those stories of those big names in Hollywood that have run-ins with the IRS for failing to pay their taxes, and they're either jailed or fined or both. Now that's tax evasion, and there's a thin line between tax evasion and tax avoidance. While tax evasion is illegal and punishable by up to 20 years in prison, tax avoidance is completely legal. The line includes gray areas like cryptocurrency and other new innovations in the world, but when people come in with made-up dependents and deductions and phantom partnership losses, that's tax evasion. The sophisticated strategies and rules that the wealthy use are all totally legal ways to avoid paying more taxes than you need to. Tax avoidance is a way of using the tax code to your advantage, like getting a deduction because you have a dependent. And this is how the rich avoid paying taxes. Thanks to the lax enforcement by the IRS and all the legal loopholes and strategies that the rich practice, this can cost the top 1% of taxpayers to avoid over $5 trillion in taxes by 2029, according to the former Treasury Secretary Lawrence Summers. The same report also found that the top 1% account for about 70% of underreporting. So how is it that the wealthy seem to be pros in tax avoidance? The answer is in tax planning. The rich have tax plans that include tax accountants that advise them on how to use new changes to their benefit, while the rest of us, ordinary people, don't. Tax loopholes let the filer avoid a law without directly violating it. In other words, they get to reduce their taxes to a point below what the lawmakers intended. Not everyone likes the term loophole because it implies that the practice is neither legal nor illegal. But for any smart, savvy taxpayer, the best practice you can make, whether you're earning a high or low income, is to take advantage of all the tax rules in the law, and that includes all the loopholes. Tax loopholes are pretty difficult to get rid of. They benefit people by saving them money in their taxes and an army of lobbyists backing it up. The loopholes might not even be political, they're more about protecting an economic sector or business that's very important. Unemployment and homelessness are the two major concerns for any government, right? So, by owning a business or having real estate, the rich are effectively creating opportunities to employ people or house them. And the US tax system creates tax incentives for those who can assist in helping those issues. Stopping tax incentives and closing tax loopholes can potentially discourage individuals from continuing to contribute to the growth of our economy. Still, the big question remains, especially during elections, should we close tax loopholes? The Biden administration is talking about some popular ones, but I guess we'll have to wait a bit longer to know whether he'll succeed. Thank you for watching this video. If you like this video, please like and subscribe. And watch these videos that might pique your interest. Thank you for your support.